Alright, so in this video, I'm redoing the memo for the 2023 accounting test, right? So I'm going to explain how the answers are obviously, displayed over here and techniques to answer these questions and conceptual framework. So let's start, right? So, firstly, you need to read the scenario very, very well. Get a picture of what they're saying over here, right? So let's start. So, number one, ignore that, round up to the nearest rand. Alright, nearest rand is probably like whole numbers, like 20,523, no decimals, right? So you're a hire shop. Now you set up in the year 2022. It's based in Cape Town. No, it's based in Umhlanga. On a low-lying property which has subject to flooding in the past, the business acquired 25 bicycles for 5,000 each with the intention of hiring them out. The business will be used for 2 years, so they'll use the bicycle for 2 years, at which it will be traded in for new bicycle at a trade value of 1,000 each. Now, what does this mean? It will be traded in for new bicycles at a trade-in value of 1,000 each. That means that the bicycles will be worth 1,000 rand at the 2 years. Yeah, so 2 years it'll be worth 1,000 rand. That's another name for residual value. So the residual value of each vehicle, of each bicycle, is 1,000 rand each. That is very, very important because now when you're doing depreciation, you'll know how to calculate it, right? So this company over here has these bicycles. It has this shop, right? But it's situated in this area where it gets flooded a lot, right? So imagine you open up a business by your home, but imagine how you're buying all these vehicles in your home, but like there's a lot of flooding in your home. So that will be very, very scary, right? Because you can lose all that stock. So the bicycles are available for hire every day of the week of an hourly rate of 50 rand or a daily rate of 250 rand. So the people who come to your shop to buy the bicycles can use it per an hour. So for every hour they use it, they pay 50 rand, or they can just buy for 250 rand and they can use it for the whole day, right? But the bicycles may not be hired for more than 1 day at a time. So that means every bike that goes out has to come back in the business, right? Because you're only hiring it for 1 day. This is a rule. Okay, and you got a deposit of 2,000 rand. So what this means, when a customer comes to your business, for them to hire the bike, they have to give you 2,000 rand. You keep that 2,000 rand. When they come with that bike at the end of the day, you give them the 2,000 rand back. This will help them from stealing the bike. Because if the customer gives you 2,000 rand, takes the bike, it most likely won't steal it, right? So when he brings the bike back at the end of the day, you give him the 2,000 rand back, right? So right now you can see, that deposit is playing like a liability kind of thing, hint, hint. But yeah. The business has a small building store to sell the bicycles and a small office, so you're operating in a very, very small place. The owner has not purchased flood insurance, right? Now, flood insurance, if you had to do it, what will it be? An expense, right? Just for information, be an expense. And will cover the cost of any damage for themselves should the flood occur. The decision was taken to extensive research indicate that flooding would be more likely to occur every 10 years. So basically, they did research and they saw that flooding will be like every 10 years, right? So what they did is this, right? They expected the loss. Okay, so they expected that every 10 years there might be flooding and the loss of this, what will happen, will be worth 50,000. This amount is accepted as a reliable estimate, right? So they're basically estimating that this amount, 50,000, is the damage that will happen with the storm or whatever. The business processes the following journal entry to recognize the annual portion of the expected loss: debit food loss, credit food damage liability. Now, what PL is? This means profit and loss. This is the income statement, right? So this means this is an expense. Now, at the end of each financial year, the following extracts appear in the financial statement. So under current liabilities, you got this food damage liability that comes from here, and you got your sales for the year 700,000, right? So the first question here: name two qualitative characteristics or useful information, and two enhancing characteristics, right? Okay. There is two useful characteristics of information. Also useful, they can say fundamental, same thing. There's only two: FR, faithful representation, and relevance. As you could see, here's it here: relevance and faithful representation, right? The second one over here, enhancing, right? Enhancing. Enhancing, there's four, right? There's comparable. It's so the way I see it. CVTU? That's my acronym. CVTU. Comparability, timeliness, verifiability, and understandability, right? Now they just say you name the two and name. So you just have to name them. You don't have to explain. But if they say explain and stuff, then you explain each one of them what it means, right? Okay, so discuss whether you agree with the recognition of the food damage liability of 5,000 shown in the statement of financial position. So you see in this financial position over here, they got you the food damage liability of 5,000. We're going to be an auditor. We're going to see that did they do that right? Was it supposed to be under liabilities? What was it supposed to be shown in the balance sheet? Your answer should refer to the relevant concepts and conceptual framework, but is not required to provide full definition and recognition. So, what is definition and recognition? That's basically like trying to tell the definition of an asset, the liability of an asset, and then the recognition. There's three things that fall under recognition: the definition, probability of future inflows, and the third one, it can be a reliable estimate, or you can measure it at a price. That's recognition. But we're doing a recognition question after this year, so you'll know what I mean. But right now they don't want all that recognition, so they want something simple, yeah, that doesn't require a lot of information and all that things, but they want you to be very very concise with it, right? So let's see. So if you really think about this, right, what the business has done here, they saying that listen here, in 10 years time we're going to, or it can happen anywhere in the 10 years, we're going to have damage to our building or our shop that cost 50,000. So what they did, they said this, right, there's 10 years, each year take 50,000 rand, divided by 10 you get 5,000. So each year we'll recognize it as a liability. So we'll keep this amount aside and we'll recognize it as a liability. So if something happens, damage happens, we can pay it. Was that right what we did? So I'm going to tell you the definition of a liability now. The definition of a liability, and if they ask you this, it's simple. It's a present obligation on a business to transfer an economic resource as a result of past events. Now you tell me, does this what they did over here contradict that? What I mean by contradict that, does it affect that, does it match that? No, it doesn't. Why? The first thing I said, the definition, it's a present obligation. Is this damage that will occur a present obligation? No. Why not? A present obligation is something that you got now because of something that happened. For example, if you failed, the present obligation for you is to study more. Oh no, that's a bad example. So let's say if you, in the contract, if you got into an accident, you have to do something. That's an obligation. The accident was the obligation. An obligation, something must have happened for it to come an obligation. So the storm over here, the keyword is future. It's going to happen in the future. So how can you say that that storm that's happening in the future is my obligation? That's not your obligation. So that's one thing you can talk about, right? The second one, the definition of liability is a present obligation to transfer an economic resource as a result of past events. Past events. Past events are liabilities. But this is not a past event. This is a future event you're talking about here. So you can literally discuss that. Now, just by that, discussing those two for 2 marks each, you got your 4 marks. And then just giving something else, whether you agree or disagree, you get the 1 mark, that's 5 marks. So the first thing when you come to this question, they want you to know, do you agree or do you not agree? Over here, I disagree with the definition of liability. That could literally be 1 mark. That is 1 mark. You're telling them that, listen here, this is not liability. Now, you tell them over here the definition of a liability and what does it contradict? What does it not match with? So you know those two things that it does not match with is the fact that it's not a past event and it's not an obligation because it never happened. So you must discuss this. In the memo they say, In order to recognize a liability, it must meet the definition and the connection criteria perception framework. Okay? So you tell them, listen here, for this to be a liability, it has to meet this criteria. But right now, it's not meeting the criteria. So what is it not meeting? You discuss. The decision by the business to cover the future expenses may not lead to a present obligation. I told you that. Second, there is no past event that creates an obligation. I told you that. The event could create. So now you're telling that, listen here. So this is a good technique to use. You use contrapositive, right? Actually converse. So they're telling over here, if you say that you disagree with a liability, one way to show the examiner or the person who's marking your paper that you know what you're doing is tell them how would you recognize this, or when will this actually become a liability. You might get extra mark for that. So the event that could create a liability or present obligation would be occurrence of the flood resulting in damage of the building. So let's say if damage happened to your business, right? It got flooding. Right now, you can recognize that 5,000 as a liability because the past event was the storm or the water that damaged your thing, and now you have an obligation. You see how to answer this question? Like that's how you answer the question. Now, the textbook, the PowerPoints, they only yap all this information to us, things that doesn't make sense, all that. So when you're doing your answers in your paper, yap. Do a payback for all the times that you yapped in the textbook and all that. You won't get D-mark if you yapped. So just like talk the most. Even get this more like 8 lines. Who cares, right? They won't mark you down. Briefly explain if anything would be different if the business, instead of covering the cost of food damage, they'll do insurance. Straight away, if the business has insurance, what will be in the financial statements? An expense, right? So your answer over here, the first thing should be the business would incur an insurance expense of 5,000 Rand each year. That should be your number one answer, right? Now, how do you get the other 2 marks? So what would be different if the business, instead of covering food, that pays 5,000 Rand for flood insurance? Now you think you just have to say expense and you'll get your 3 marks. No. Because we're doing conceptual framework, you must see why it's an expense. This is proving. So you can't just say it's an expense and done, end of story. You're doing a question on conceptual framework. You have to have proof. This is like paper 2 geometry. You can't say something without proof. So because you said over here it happens as an expense 5,000 each year, you need to prove via conceptual framework that is an expense. You see what I'm saying? So, as per framework, 5,000 insurance will result in a decrease of bank. There is no change in other assets. So, for an expense, what does it mean, an expense? For an expense to happen, your assets must decrease or your liabilities must increase. So because of your assets is decreasing, it's an expense. You see what I'm saying? Now you conclude, therefore, the buy-high equity will decrease, not due to the owner. So anytime you have an expense, say the equity of the business will decrease. If it's an income, the equity of the business will increase. You're just adding information to get marks, right? Okay, so yeah, not a transaction with the owner is very, very important. Income and expenses doesn't happen with the owner, right? Covering the sum for food liability damage results in no expense being recognized as there is no decrease in equity or liability. So here you can like go on to the previous question and say why that won't be an expense, right? Okay, so number 4, briefly discuss with reference to conceptual framework how deposits received from the customers whose bicycles are hired should be recognized in the financial statements. Your answer should include the definition and recognition. Now, this question is a bit different and it's a bit tricky and it's a bit critical thinking, right? I want you to really think about this. If now, as soon as you see this, always refer to the balance sheet they provided you with. They don't have anything but deposits over here. Now, I might be thinking why? Because deposit, under it should be under your, okay, see, if you okay, now don't get confused, yeah. If a customer gives you a deposit, that's a liability, right? He gives you to keep that money and then you have to give him back. But if you like pay a deposit for a vehicle, that's an asset. So don't get confused. But what I'm trying to say here, the customer is giving you 2,000. How much is giving you? Let's see how much. 2,000, yes. So the customer is giving you the 2000 rand to keep it, and you must give him the 2000 rand back. So in my head, it's a liability. But then you may ask, why is it not over here under your current liabilities? So now I have to say, like, why is it not under my balance sheet there? Because I know it is a liability, it should be there. So that's the technique you should use when answering this question. So if you think about it, right, in the question, right, they say here, the business may not be hired for more than 1 day. I mean the bicycles. So what does that mean? So if a person takes a bicycle in the business at 8 o'clock, he must return it before 5 o'clock when the business closes. So at 8 o'clock, the customer will give you the 2000 rand. And at 5 o'clock, you give him the 2000 rand. The next day, he gives you the 2000, you give him back. The next day, you give him, he gives you back. So if you think about it, at the end of the day, when you're going home and your business is closed, do you have any 2000 rand with you? No. So that means you really don't have a liability at the end of the year. Do you get what I'm trying to say? It's a cycle. Don't get me wrong. When you have the 2000 rand with you, it's a liability. But it won't be represented in the financial statements at the end of the year. Because each time your business closed, you already gave the 2000 rand back to the customer. Okay? When you come to university, if I give you a pen, and then at the end of the day when you go home, you give me that pen back. Every time you go home, you won't have that pen with you, correct? So that is what I'm trying to say. You won't represent it as the end of the year balance sheet. Yes, when you got that pen with you, it's a liability. You owe me that pen back. But at the end of the year financial statement, you won't put that as a liability because you have no, when you go home, you have no pens. Because you're giving them back before your business closes. That is why it won't be that. So, deposits received for the hire bicycles are repayable when the bicycles are returned. So you have to tell them, yeah, listen here, this is a liability. Why? Deposits received at the hire of bicycles are repayable when the bicycles are returned. But now you say that why is it not in the balance sheet? Since no bicycles are kept longer than a date, there would be no deposit held at the close of the business at the end of each day. Therefore, at the year end, the deposit would therefore have no impact on the financial statement. The business would recognize the liability when the cash deposit is received. You have to say that, yes, there's a liability when the cash is received. But, received. And then, deposits, you can also say other stuff. Conceptual frameworks always want you to think out of the box. Then you can say income is not recognized as a deposit have not been earned. So to be honest, I don't know why they say that. I mean, I guess they just want you to think, right? I mean, it's obvious that that's not an income. I mean, they just gave you that 2000 rand to keep. But if they're giving you a mark for that, I say put all those nonsense. They might give you the mark, right? So yeah. So you must say why that deposit won't be an income or so on, right? You can say that. You just see how much you can say in these conceptual framework questions. They're not gonna mark you down if you give things. Also see how each one is like a point over here. So in what I suggest you in your paragraph when you're writing conceptual framework, your first point should be like 2 sentences, and each point what I mean is leave a space, so they see your construction of sentences. Okay, so now we're on part B. Okay, on the financial statements have completed, the bookkeeper discovered that a 3-hour bicycle rental has not been recorded. Right. So a 3-hour bicycle is how many rands in total? Every hour, how much is the rate? 50 rand. So that means 50, 100, 150. 50 times 3. So 150 rand worth of this sale that you have is not recorded, right? How will this affect the omission? How does it affect the financial information produced by the financial statement with specific reference to materiality? Right. What is materiality, you may ask, right? Materiality means if omitting something affects the decision making of the user of financial statement. What does this mean? Something is material or immaterial. Something that is material means you have to show it in the financial statements because it is important for the person who's reading the financial statements. If you leave that thing out, it's bad because the person who's reading the financial statements need that information. Immaterial is the opposite. It's something that is very, very small. If you don't put it in your financial statements, it's fine. If you don't show it in the financial statements, it's fine because it will not affect the person who's reading the financial statements, right? So the first thing when you talk about materiality in this question, you first need to know whether they're talking about something that is material or immaterial. That's one mark. Second, you need to explain. Third, you need to conclude. So this 3-hour bicycle we calculated to be 150 rand worth of sale. Now, right now your sale is sitting at how much? 700,000. Right, 700,000. So you tell me, will 700,000 you got in sales be affected by 150 rand? Well, if your financial statement, if you had to add this 150,000 rand, 150 rand, it'll be 700,000 and 150 rand. But if you left it out, what you did is now 700,000. Is that a big effect? No, so it's immaterial. So no big deal if you left it out. It won't really affect the matter, right? Because it's immaterial. So what they said over here, information considered material. So you give the full material definition, which I told you. In this case, the business would have received 159 from the hire of 3 hours. So you have to say that, listen here, you still have to give all this information that, listen here, 150 rand would be what a sale should have been made. Given that the sales income of 700,000 rand, a profit at 198,000, the omission is highly unlikely and influence decisions, so there's no insufficient impact. You see what I'm saying? There's no impact. So that is why it's immaterial, so you can leave it out. And then you can do a calculation over here, right? That it's a very, very small percentage of the sales. So I would just include the first one, right? You take 150 over the full amount, it's only 0.02% of the sale. So that's proving that it's not much. So if it doesn't affect it that much, it's immaterial. So you're allowed to leave it out. Don't get me wrong, you should have included it in your sales, but now you forgot. But you're not going to make a whole financial statements just to make it correct, you know what I mean? So C. One of the owners requested that a business pays a drawing to each of the owners, but is unsure what is the impact this would have on the profit of the year. So one way of thinking about this, what would be the recording journal entry when you do drawings? That's how you should think. It'll be debit drawings, credit bank. So let's say the owner want to draw out money of 100 rand, debit drawings, credit bank. So think about this very, very carefully. Like debit drawings is an equity. Bank is an asset. Is income and expenses being affected? No, right? So the saying over here would have an effect on the profit for the year. How do you calculate profit? Simple. Income minus expenses. So if the two accounts, which is drawings, equity, bank, assets, equity and assets are being affected, will it affect profit, which is income and expense? Absolutely not. So you have to say this, listen here. Drawings is a distribution to the equity claims. Or another way to say is, drawings is what the owner takes out from the business, right? Any drawings paid to the owners will not impact profit of the year because profit is only income and expenses. Drawings only affects an asset and an equity. Although drawings will result in a decrease of net asset value, remember, net asset value is your equity. So obviously equity is going to decrease in your business because it's an expense. It's an equity. Drawings an equity. You're debiting an equity. That means it's going down. So although the net asset value will decrease, transaction with the owner and therefore not meet the definition of expense. Yeah. So because drawings is a transaction with the owner, it's not an expense. Because according to the conceptual framework, expense means that it's not got to do with the owner. So you have to say that, right? Part D. Another owner is interested in the accounting system and wants to inquire about the adjusting journal entries and closing. Right. Now, what are adjusting journal entries? So you know how at the end of the year they make you do your financial statement in the test and all. They say like accrued income, accrued expense, income received in advance. Those are called adjusting journal entries. So you basically have to look at the conceptual framework and say that according to the accrual concept, you can't, like for example, if a person who owns a person who owes rent for next year, but rent for this year, but you never pay it, you record it as an accrued expense. So like you have to add it to the rent. You see what I'm saying? So those are adjusting journal entries. So adjusting journal entries are prepared to report the financial information in the financial statements. These entries adjust which has been recorded to ensure the financial statement reflect the economic reality of the business at the reporting date, and they reflect the correct amounts if adjusted when record what should have been reported per IFRS according to accrual basis, thereby making financial statement more accurate and relevant. So here they're using complicated words, right? But you can say this. You can say that adjusting journal entries happen because according to the conceptual framework or according to the all IFRS, which is International Financial Reporting Standards, there may be some amounts which you have to adjust. Adjusting these amounts is important because it aligns with these conceptual frameworks. One of the example of this is like the accrued, what is called accrual basis. Now you'll discuss what accrual basis means. It means all income and expenses must be recorded for that particular year. Then you give an example. You never pay your rent expense for this year. You have to still record it. So that's adjusting journal entries. Then you have to say that there are specific rules entities have to follow according to the laws. So you just like make your own things up, but according to this, huh? And then obviously you can say that all financial statement needs to follow this. They need to all be the same. So they by adjusting journal entries, it reflects the correct amount of financial statement. So you see, so I don't have to look at this memo and see my answers. As long as my answers make sense in life, it's fine. And what are closing journal entries? So closing journal entries is only one definition, is when you close off all income and expenses. So if you know accounting 101, you know when we had to close off all income and expenses to your retained earnings, and then from retained earnings, that's how you get retained earnings. Yeah, basically it's the same concept. So closing journal entries are prepared after adjusting journal entries. Okay, so yeah, that's very important. After you adjust journal entries, then you do closing. So you must say that at the end of the financial year, always at the end of the financial year, right? In order to close off all income and expenses to the equity and calculate profit. Equity account is also retained earnings. That's an equity account, calculate profit. Okay, so yeah, to calculate profit, you have to close all income and expenses, obviously, right? Because they cancel each other out. For example, income minus expenses will give you a profit. So in doing closing journal entries, they kind of, on the debit side and credit side, you bring your balance down, you get your profit for the year. That's basically it, huh? So this one here is a bit challenging. Well, not challenging. It's just a lot of thinking. The owners have told that the initial recognition of bicycle are measured at cost. What does that mean? What is initial recognition? It's what you first put the bicycle's worth in the financial statement. If I bought a vehicle, if I bought a vehicle for 10,000 rand, the first time I record this in my financial statement, vehicle 10,000 rand, it's called initial recognition. This is year zero, the first time I bought it. They have been told that each reporting date, so that's like each year, after you buy it, acquisition buy it, subsequent measurement will be considered. Every year, subsequent measurement will be considered. Subsequent measurement means that you will basically that price at which it is worth when you bought it will no longer be worth that price. Obviously, because of depreciation, right? If you buy a vehicle worth 100,000 rand, you will account for depreciation. So let's say 2,000 rand, and now your vehicle is worth 98,000, carrying value 98,000. Basically, what I'm saying is you have to adjust the value of that particular good, that particular asset you got, because of depreciation. Right? Also, subsequent measurement mean you have to in the conceptual. See, we're talking about conceptual framework here. So subsequent measurement, it tells you how in the subsequent measurement. What does it mean? It means depreciation. It means impairment, all that, because whatever changes the original value of the thing, which is your initial measurement, for example 100,000, what can make the value go down? Depreciation. Correct. What else can make it down? Impairment. So you have to talk about that. Now, I might be thinking, what's impairment and all? I'm gonna tell you just now. It's fine. um okay, bicycles the end. So now let's together go through this and explain, right? The first thing you need to do here is explain what the definition of measurement is. That's the first thing you need to do here. Measurement refers to the processes of determining the monetary amount at which each element of a financial statement are recognized and reported and appear in a financial statement. That is accounting value. So what this means. So in the financial statements, you know how you have amounts. For example, vehicles you'll have 100,000. Inventory you'll have 50,000. Those are called measurement. So how much do you record that is worth in a financial statement. The monetary amount is the money amount, right? Same thing, money amount, the actual money. Now, the business will recognize the cost of using the assets through a process called depreciation. So obviously, when you're looking at the subsequent measurement, you're taking into account depreciation. But somehow you have to also include what depreciation is. You see how conceptual framework is getting at your brain. So that is why the cost of using the vehicle, the asset, which is the bicycle, is called depreciation. The bicycle, High Africa will identify the depreciation amount of business and recognize the expense over the economic useful life of the vehicles, bicycles. So that's common sense, right? You'll record depreciation at every year. Now you'll want to calculate depreciation, because they're saying over here, explain fully the process of establishing the carrying amount. So they actually want you to do the depreciation. Very, very simple, right? Depreciation. I'll tell you what's the formula. Depreciation, the formula is costs minus residual value over number of years is equal to the depreciation 1 year or every year. So what this means? So they said over here, wait, where's that thing where they say how much it is worth or whatever? Let's see, because I told you that here's a job. Bicycles are worth 5,000 rand each. It has a value of 1,000 rand at the end of 2 years. So 1,000 rand is your residual value, 5,000 rand is cost. Formula cost minus residual value over what is the lifespan of the asset. So you see 5,000 minus 1,000, that's 4,000. That appears on top of the fraction divided by how many years it's been used for? 2 years. Divided by 2. That's 2,500. 5,000 minus 1,000 is 4,000 divided by 2. That's 2,000. Yeah, 2,000. So each year it'll be 2,000, right? It does make sense, right? Because second year it worth 1,000 each. So the first year it goes down by 2,000, it'll be 4,000. Sorry, it'll be 3,000. Second year goes down by 2,000, that'll be 1,000. That's how I get 1,000. So again, 5,000 rand minus 1,000 rand over 2 will give you depreciation each year. This is what they did over here, you see. So that will give you the depreciation each year. So you tell that, right? An amount of 2,000 will be recorded as depreciation expense. Now the carrying amount of each vehicle will be reduced by 2,000 rand each year. The amount of each vehicle reported as 3,000 as 1 year and 1,000 as year 2. See, I even told you that, right? So now, you told them the depreciation, but you must tell them each year what will the carrying value be of the thing, right? The vehicle, the bicycles. So right, now you're discussing impairment. So you can even give the definition of impairment over here. Because in your subsequent measurement, you have to include two things, depreciation and impairment. So now you have to talk about impairment. If there's an indication of damage to any vehicle, the impairment test will be conducted. You might ask what's an impairment test, I'll tell you. The amount of vehicle will be compared to the recoverable amount. Okay. Now, impairment. If the recoverable amount is less than the carrying value, that means you have to impair the asset. What does it mean? If your recoverable amount is 10,000 rand, but your carrying value of the asset is 15,000 rand, your impairment will be 5,000. Now, what does it mean? So wait, what I said, 15,000 rand is your carrying value, 10,000 rand is your recoverable amount, 5,000 is your impairment, correct? Okay. So what is impairment, right? What is the recoverable amount? The recoverable amount of the bicycle is determined as the higher of the value in use and net desirable value. Very complicated way they're saying this, but I'll tell you what. Higher of the two, higher of it means it's the higher amount of value in use and your net desirable value. Now, net desirable value, I seriously don't know why they say that. Another name for net desirable value is your fair value minus the cost to sell the product, right? So you're looking at these two costs, the value in use cost and the fair value minus the cost to sell the product. Whichever one is higher, that's called the recoverable amount, right? Now, value in use, the way you calculate it, to be honest, I don't think they'll test this because value in use, I don't see any calculations that they're using to test this, right, in our books or whatever. But basically, if you can picture this, right, if you can really picture this. Let's say value in use is like it uses the present value formula. So if the first year your value of your or the amount which you're going to get the inflow of your bicycle, let's say it's 10,000 rand. Second year is 5,000. Third year is 1,000. With these amounts, you use the present value formula. Present value formula is present value is equals to future value over open brackets 1 plus I close brackets to the power of n. Right? N represents the years. I represents the interest rate or inflation rate. And yeah. So so I'll tell you the full calculation. Let's say if the first year is worth 10,000 rand, and they'll give you the interest in the question. So you'll say 10,000 rand over open brackets 1 plus 10%, close brackets to the power of 1 because you did first year. Then you say plus the second year, what I told you it was worth. Okay, let's say second year was worth 15,000. It'll be 15,000 over 1 plus the interest, close brackets to the power of 2 because the second year, plus. And the third year, let's say it's 18,000, so 18,000 over open brackets 1 plus the interest rate, which is like 10%, close brackets to the power of 3. And it calculates all the sum of all those numbers. That's your recoverable amount. I mean, that's your value in use. That's how you calculate values, but I don't think they're going to test that. But this is what they usually test. The fair value minus the cost you sell it for. So if they tell you in the question the fair value is 10,000 rand, the cost to sell the good is 1,000 rand, then obviously your net desirable value is 9,000 rand. So the highest amount of those two, right, is your recoverable amount, right? Mostly it'll be this one. So now the bicycles cannot be carried or reported in the financial statement amount if it's greater than maximum probable future economic benefits. So that's another way of saying if the amount which you're going to receive, the economic benefits, the inflow, which is your value in use, is less than the carrying value, then you rather impairment it. If the carrying value exceeds the recoverable amount, impairment will take place. I told you that, right? Now, in case of bicycle hire, each bicycle will simply be reported at the balance sheet at carrying value cost minus accumulated depreciation, as there is no evidence suggests that the bicycle need to be impaired. So the reason why we can't impair it over here is because. So let's see. So now the vehicles are worth 1,000 rand at year 3, right? There's no need to impair it because the market value it's 1,000 rand, right? And now you need to compare it to the carrying value. So like they're not okay. So if they tell you in the question that like the value in use, the market value is something, and then they give you the carrying value which is higher, then you do the impairment. Also, if they tell you it got damaged, the vehicles got damaged, bicycle got damaged, then. But over here, nothing happened, nothing got damaged. Depreciation is a bicycle normally each year, like you usually do. Nothing got damaged, so it's fine, right? So you tell them that they don't need to do a impairment, and obviously you tell them how you represent the amount in the balance sheet, right? So that's it. So in the conceptual framework here, you just need to know how to do this, huh? Know how to yap, know how to talk nonsense. We do this every day, so we won't have a problem with it, right? And that's it for conceptual framework. Don't forget to like and subscribe.